Welcome back to the Australian Retirement Podcast. I'm here with the not so fit Drew Meredith. Well, literally.
It was a rough start.
Welcome, mate. It is lovely to see you. Can't wait to get stuck into that one. But before I do that, how are you doing? What's news in your world?
Always love that intro. We're nearing the end as we record in August. We're nearing the end of winter in Melbourne. Apparently, it's been quite mild, but if you've been out at all early in the morning, it has not been mild whatsoever. I mean, you can't really compare if you live somewhere in the northern hemisphere, I'm guessing. But been well, keeping busy. Pondering my own retirement.
Yeah. I've got a bone to pick with you.
I somehow dragged myself in here this morning. I'm not sure how.
You were telling me this morning that you were playing basketball,
yes, still getting around. I'm the 42-year-old. Our team is all over 40, and let's just say we're beyond our peak in terms of our competitiveness is still there, but our sporting talent is no longer where it was 20 years ago, and the teams we play happen to be half our age. Like, most of them are in their 20s. The oldest team is probably 25. It's quite challenging, yes. And somehow, everything since last Thursday night has been incredibly difficult for me to do. Be that breathe, be that bend over to pick up my children, to turn around in the, when sometimes that back door in the car's unlocked and you have to turn it. I did that this morning and almost, it was the most difficult, painful thing I've ever done.
So someone's hit you in the ribs, and that's Yeah.
I got a nice little elbow to the ribs. I say it was because I was playing such good defense. Let's just say something like that. Yeah. I thought it was fine. But apparently ribs kind of build up over multiple times, at multiple days. So day 1 was fine. Day 2, okay. Day 3, really bad. Day 4, even worse than day 3.
Okay.
And we've got there today. Still, I thought it was better when I woke up. It was not. I'm very afraid to sneeze at the moment, which raises the question, what is the trigger to quit competitive sport? And it can't just be age-based. And I believe you're not alone. I'm not alone here. You're sitting over there on your high horse saying, "Yep, you shouldn't be playing contact sports." But you lived on in here this morning too.
There's no high horse for me either, mate. There's a rolling wheelchair at uniform height. I have a similar story, which is that my little boy Finn, he's at primary school.
It's child related.
Oh no, thank goodness no. But he's at primary school, and the dads from two competing, so to speak, primary schools are local.
Competing be the key word.
Yeah, local primary schools have a footy game once a year. Just get together, and so the training for this is basically just kick the footy to each other and have a couple of tins before you leave. Yeah. That's Sunday afternoon training, and we were just doing a little bit of lane work, and I just sort of just marked a ball and ran forward and just. I thought I might just try to drill this one and popped my hammy.
So that was in training.
That was not even in a game. Yeah, that's right. That was just doing light lane work. So
not even kicking a ball in anger.
Yeah. So that was so I've got a grade 2 tear on my hammy. One of my good mates was like, "So grade 2, was that because you were playing grade 2s?" Which might as well have been. I've got a little bit of a limp too. So let's start by saying the time to quit competitive sport is obviously before our age.
Following an injury.
Yeah. It is. It does give you some perspective though, because I'm thinking back to the podcast that we had a little while ago about longevity and well-being and so on. My wife Lou made the point that you exercise and you go for runs and ride a bike and that sort of stuff, but you do very, very, very little stretching.
Yeah.
And that was probably
a similar message I get at times.
That was probably fine when you're in your 20s and feeling quite supple. But that word has long since departed my body and my vocabulary. So it's a sign for me that, like, if I am going to do anything even remotely fun from now on, you actually need to build a pattern.
Time to go to some yoga.
Reformer Pilates or something.
Well, health's so important when you get to retirement. So, and I think injuries like this are just taking away from the stuff that's important, like the muscle building and as we know, bone density reduces once you're in your 40s. So I think I'd be doing that on a podcast episode. But I think that's when injuries are taking away from the rest of your training. I think that's nearly time. Hopefully my partner's not listening to this because she'll expect me to retire this week.
If we can edit that bit out, that'd be great. Thank you. Yeah. Okay. Well, you're dealing with 2 old men in this show, so we'll do our best to maintain the energy throughout. Let's get across to our boomer briefing. We had a couple of things to talk about. I might throw to you because you're talking about something interesting this morning around platforms. Do you want to speak to that?
And no comments on the Boom Briefing title so far, which I'm really surprised.
Yeah, it's here to stay.
Yeah, it's saying there's not. Get on YouTube if you want to have feedback about the title of this one.
I think at this point, if you're a boomer, you're a proud boomer.
Yeah, exactly. There's no okay boomers around here. I mean, platform. This question comes up all the time. We're meeting, and I think quite unique and probably similar for yourself, that we're meeting lots of people looking for advice for the first time or that haven't had advice for 15 years. So it's a very different environment to someone who has had an advisor and is switching advisors. You kind of have naturally absorbed the complexities that come around advice and the different systems you can use. So we always get this question, which is what sort of super fund do you use, and in particular, what's a platform? So there's 3 types of superannuation funds. I mean, technically, probably 4. Depends how much detail you want to get into. You've got your industry member, profit for member super funds. Your ARTs, your Australian supers, and at the other end, you've got self-managed super funds. But there's this little sweet spot in the middle, which historically, but I think both you and I didn't love. Historically, being at the beginning of our careers, probably 20 years ago. We did everything by hand and everything was just done direct. But this part in the middle called a platform, which is basically a wrapper. So if you go to an industry super fund, you get the industry super fund is the trustee of your super assets as well as the investment manager. When you go to a platform, the platform is the trustee of your superannuation assets, but you can employ someone else to manage the assets. I think that's where it's quite unique. And I think historically, these are software based. A few of them are listed on the ASX. You go Hub24, Premium, Netwealth, and obviously Colonial First State, owned by the Commonwealth Bank.
And you got BT Panorama, which is owned by Westpac.
Yeah. So they're still huge multi-billion-dollar tools. But basically, we're seeing, I think I'd say 2 years ago, almost every person came in wanted a self-managed super fund and was interested in a self-managed super fund. Essentially for that high level of control and the transparency that they get from it. But more and more we're seeing the benefit of that option reduce unless you're investing in property, which we know from your video and widely spread AFR article that as you know, borrowing within an SMSF isn't necessarily that valuable. So for people just looking for control and with the flexibility that's coming into the platform world, it's become increasingly attractive from an advisor's perspective, and I think as well from a client perspective. So essentially what it allows you to do is have control over your investments, have more transparency than you could in an industry fund. So see down to the level, down to the dollar where all your money is invested, but adds a few additional areas of benefit. One is a wider selection of investments, but one that I don't think is talked about enough and particularly relevant, I know you did an episode on scams recently as well, is it offers this additional layer of protection from scams that you don't, and phishing and all these other attempts to get your money out of your pocket that you don't necessarily get if you're just invested via an SMSF, which is very direct and just a bank account. And we know what a lot of the scams are doing now. They're just asking you for details while they're on the phone and transferring money out of your account once they've already hacked you, and probably just as relevant with Qantas. I realised I was part of the Qantas, the Optus and the Medibank releases of information.
So your phone's ringing every 6 minutes.
About me,
yeah. Oh, God.
Everyone knows everything. But it adds this additional layer of security and cybersecurity that I don't think is as widely appreciated by advisors or clients. But this probably links to one of your Boomer briefings this week, but the costs of a platform has become commoditized. Historically, it cost you, $3,000, $4,000, $5,000, and the cost would keep going up. Now, a lot of the time, you can have a capped price, spread it across multiple accounts, so you're not double paying on fees, and the scale benefits for a client become significant, as well as the benefit of not having to, deal with reporting, not dealing with your accountant as much every year, and hopefully reduce costs elsewhere. You're getting a similar experience and trend with platforms?
Yeah, I think you explained that really well. And I think
my little soliloquy.
Especially when you're engaging with a financial advisor, one of the primary things that an advisor should hopefully be doing for you is asking you good quality questions about the sort of investments that you'd like to own and understanding your risk profile really well and trying to build something in that space.
It probably segues to our last.
It probably does. And so if a platform, of course, offers more selection, offers more. So if you take a traditional let's just say use a simple analogy of saying, all right, I've got this, like one of my best mates is one of the best chefs in the country, an unbelievable chef, and they're going to make me dinner. They're going to come over to my place tonight and make dinner. Well, if all you've got in your pantry is 2-minute noodles and, like meager noodles
really
and a
good
can
at
of tuna.
Yeah,
thanks. If that's the scenario, it doesn't matter how equipped the chef is, you're really not necessarily going to get you're not going to get an incredible meal. A broader range of options available in the pantry and in the fridge is going to allow that chef to make something that's more bespoke and better suits what you're after. Now, the solution isn't always let's move straight to high complexity. You've got to have 800 investment options on the menu. But if you are going to an advisor and part of your objective is I'd really like to make sure that I'm invested precisely in line with both my risk profile and also my investment preferences, it stands to reason that having more investment options is going to help there, and a platform is really good.
Yeah, for sure. And a lot of it's off the shelf. In most other places, if you go in an industry fund, it's off the shelf and it's suited to the masses.
Yeah.
And this allows higher levels of tailoring. One
of the things that at the very beginning you were saying that, and I agree, in the very early days, one of the issues with these platforms is that they hadn't quite got it right. They didn't have enormous investment venues, A, and B, they were expensive. Yeah. And so you added both of those and they weren't such an attractive offer. Yeah. And I see this really, really lovely race to the bottom on both sides. On one side, from a platform perspective, the fees have continued to come down. There's been more compression as more platforms have come to the fore. Yeah. And that's wonderful because whatever the average fee is for a superannuation fund, that is coming down over time, and that's wonderful for Australians. But also at the bottom, and let's go back to your industry funds, for example, it's really nice to see that they are realizing that our number one competitor, aside from another industry fund, is a platform that has more investment options. So how can we get better? How can we improve our menus, give more options so that, for example, it's still the case with a lot of industry funds that, let's imagine they've got the high growth option, which for simplicity has 50% exposure to shares and 50% exposure to, or say 70% to shares and 30% to property. Just use that number simply. If you say, no thanks, I just want to invest in shares, that sleeve of shares is identical. It's exactly the same allocation. All the assets are the same. You're just choose. It's that Henry Ford, you can have any color you want as long as it's black type scenario. So if the actual portfolio is performing badly, like that specific sleeve of that investment, you can't say, I'm happy to be invested in shares. I just don't want to be invested in your portfolio of shares because they haven't performed well. Yeah. You don't have that flexibility. There's no options. But you do with a platform. So I agree. I think that they were a really valuable middle step when you don't want to take the fully fledged, I want absolute control over everything, and I want as much flexibility with investments as possible, the way that you can get through a self-managed superannuation fund. But also I want more control than just perhaps the limited range I have with a traditional industry super fund. Yeah,
and I think the comparison between options is becoming easier to do, I think, as that commoditization occurs. Because if you think you're generally looking at anywhere from 0.1 to 0.15% for an industry fund, you're now looking about 0.15 to 0.2 for and these percentages go down as you increase your balance on a platform. And then you have basically a fixed cost for an SMSF that just for the accounting work is anywhere from $3,500 to $5,500. And you think, so depending on what your balance is, you can get a pretty good idea of what your admin and your super cost is, and incredibly comparable across all three.
Yeah, agreed. Yeah, happy days. Well, I've got something to add to that.
You've got a bone to pick as well here.
Well, I think it's more just something to be aware of, which is that I recently had someone come to the business and was talking about their situation. And they explained that they were saving about, was it $1,500 a month, somewhere in that sort of zone. So great work, and specifically that money was getting allocated toward a share portfolio. Yeah. No worries.
Like robo investing or?
No. This was through CommSec specifically. Yeah. And so they're getting this $1,500, and then they've got a portfolio of a number of different equities, probably about 30, and then they're spreading that $1,500 amount every month, 200 there, 100 there, 50 there, 200 there.
I can see where this is going.
Yeah, of course, because what this individual wasn't thinking about is the transaction fees associated with those buys. So let's use, from recollection, I think CommSec is $9.95 for most of the smaller transactions, but this individual was probably making 8 to 10 transactions per month with this $1,500. Now, the problem is that if you're at that's 6%, like 6, we'll call it 6% is pretty much the number. So they're losing 6% in contribution
every
fees.
Trade. It's like stamp duty, like if you bought a house.
That's right.
It's the same amount.
It's wallopingly bad. And I think this is something that a lot of people aren't necessarily aware of, which is that if we said, hey, let's set up an investment for you and we're going to have a 6% contribution fee, it would be disgusting. Like, that's so much money to spend. You really do have to think about the impact of transaction fees if you are in the habit of making small, consistent contributions. Now, that can be negated a couple of ways, right? The first way is you might only pick one, max 2 investments with your $1,500 a month, and now you're at $20 of transaction fees, which is still 1.5%, by the way. It's not insignificant, but it's a lot better than 6.
And it's focusing on materiality. So what's the materiality of the purchase that you're making? If it's a small amount, is it going to impact on the diversification of your portfolio?
Yeah.
Probably not.
Probably not. Yeah. Number one is invest in chunkier amounts, even potentially waiting for multiple months to put in bigger amounts. Be curious to run those numbers. In fact, as I was running them just on the fly, if you had a transaction fee of $10 a month and you were doing $1,000, then you would be worse off doing it every month in my numbers, because that would represent 1% of your overall.
This now?
Yeah. So 1%. So every month there's a cost of 1%. So compounded, you'd need let's say for simplicity, not quite, but you'd need 10% per annum in order to justify putting out money in that particular month rather than waiting. So
it's almost the same as stamp duty. Like when you purchase a property, you're almost 8, 9, 10% down as soon as you purchase that property, and you're not going to make that up. I mean, generally not going to make it in the first year.
Certainly not straight away. Yeah,
we build a strategy into that. So this is why we have always, and we've questioned, and we kind of thought about not doing it at different points as well, but we always do quarterly reviews of client portfolios. And I think having a regular cadence is key to, one, making sure when you make these decisions they're material, that they're considered, but also that you're allowing the capital to build up and allocate it to this. In our view, it's the way you do have the best chance of buying the losers and selling the winners, because you're not just doing it reactionary when the money comes in. You're doing it as part of a pre-planned and prepared process, and people can do it at home. You just set a reminder every quarter, and whatever balances there you do it. And we do this with, if it's clients that are rolling over from a corporate super fund or a industry fund, we don't just do it every month and have $5,000 dribbling in. Let's do it at the end of a quarter when it's significant, and then you're going to get a benefit out of investing it, as opposed to just racking up transaction costs.
Well, to add to that, there's one other way that you can reduce this, and that's if you had depending on the platform, if you had a focus on purchasing managed funds rather than purchasing ETFs or direct shares. So most platforms, including CommSec, if you buy ETFs or direct shares, you'll pay a singular transaction fee that relates to that purchase. Whereas with a managed fund, more often than not, you have what's called a buy-sell spread. And that is a percentage amount that relates to the purchase of that investment. Now, the benefit is that because it's percentage-based and not a minimum hurdle of, let's say, $10 or $20 or whatever the number is, then on much lower purchases, you're still getting charged the same very minute amount. Now, all that said, there are lots of people that argue that I want to be in ETFs anyway because long-term fees lower, and there's some other benefits to that. We could speak to that in a totally separate episode. But if you do have the desire to make regular investments and really be contributing on a weekly, fortnightly, monthly basis for small amounts, there's probably a pretty good argument for you to look at the managed fund version of this ETF by contrast, and then invest in that, knowing that yes, the management fees are marginally higher inside, but I get the benefit of not paying the transaction fee on the way in.
Every single time I go in, Yeah, I think great point.
Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you or you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. you may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here, and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it.
And we've got anything but exciting. A very, very timely question coming through today, and I think it's been in the media a lot. And it's I think a great example allows us to go through what happens when something goes wrong with investing or financial advice. So today's big question comes from Distressed, who says, a few years ago, I saw an ad on social media to boost my super, air quotation marks. The ad was from a business called First Guardian. I spoke to some people who switched my super and established some insurances for me. Over the next 18 months, I started to get a bad feeling from them. They would never action my inquiries and I was thinking of leaving. I was too late, and First Guardian froze all my assets. My super balance has just fallen from 134,000 to 40,000. What is going to happen to my super? So maybe it's worth giving a little bit of background on what's happened with First Guardian. It's quite a complex, and the aim isn't to go too much detail and make judgments in this.
No, I'm happy to make judgment.
But let's give us a little background on what First Guardian is, and I feel the Shield Master Fund comes in here as well. What's happened? I think we'll probably go back and forward on this, and it could riff for another 45 minutes. And then let's talk about what happens to investors that have been stuck in these First Guardian assets.
Yeah, thanks. And I think it'd also be prudent for us to perhaps at the end talk about how can you avoid this, because the thing that is so painful about this is that First Guardian was a financial planning business.
Yeah, what do we always say? Make sure they've got an AFSL. Make sure they're
on the Financial Advisors Register. And
research reports.
And
everything.
They were. Yeah. And still they did this, which just speaks to the fact that there still are some bad actors, and this is one of the worst cases. 11,000 people impacted. First Guardian was a financial planning business that operated incredibly heavily on social media sales. So no surprise to hear that they saw this ad on social media, boost my super.
Yes, compare your super, get a better return from your super, all these kind of greed triggering social media ads.
Yeah, and please take this with the good nature that's intended. If you've been affected, often they would they prey on people's lower financial literacy, not necessarily knowing the performance of their existing funds, and not necessarily having a great handle on their superannuation. They also preyed on people that had, from what I can see in terms of their marketing campaigns, preyed on people who perhaps had more cynicism about either their super fund or the performance of their super funds. Yeah. So, in a lot of cases, there were people that rolled their money over from super funds that were performing perfectly well, top quartile super funds, but they were curious and perhaps a little cynical and about where they were, and they got in touch and were sold a dream and moved. So the focus was around just switching super as quickly as possible. We'll move you from Fund A to Fund B, and we'll charge you a fee for that. And also, where possible, we'll write some insurance for you because we get a commission for that. Just to be clear, don't mistake this in the sense that there are, for example, I think about Phil Thompson, who has Sky Financial. They're an insurance-only business. They get paid in commissions, and I think they do an incredible job. It's not so much about that piece. Yeah. It's more about the focus was not about not ever about the client. It was about lining their own pockets. Much worse is that First Guardian were making recommendations for funds that were conflicted. So these are the First Shield Master Trust, which the First Guardian directors had a very, very high stake in, if not all.
Yeah.
And so not only are they making bank by rolling super funds over and charging a fee to roll from Fund A to Fund B, but then they're also making ongoing bank by making with an extra clip of the ticket
into their own product.
Into their own product.
Like I think was it property or property apparently property, or maybe a part of it was in property or property lending, or associated businesses that were then paying salaries or dividends or money out to the people who also own them. Yeah. And that's very hard. Like, to even find that out, you'd have to do as an individual investor that, as you said, is probably less informed about superannuation law. They'd have to be doing ASIC searches to find out who are the owners of these businesses that their money's going to, if they even knew where the money was going.
Yep.
They wouldn't have, I think they would have got a very simple performance report, if that.
Yeah. Well, and the other concern here is around the actual validity of those performance reports, because there are some very well directed concerns that these this was a Ponzi scheme, and it was designed for it was just new money in was funding any inflows on the way out,
redemptions, and a Lamborghini, I think, and a apartment in South Yarra, all kinds of which clearly is fraud. Let's be 100% clear on that. Yeah.
So what's happened here in this case for distressed? It's been written I was too late and First Guardian froze all the assets. Well, to be clear, it wasn't First Guardian that froze all the assets. It was ASIC.
Yeah.
So the Australian Securities and Investments Commission stepped in, and after what I'm led to believe was an infuriatingly long time of asking them, saying, hey, we're a little bit concerned about this. This has been a known issue for a long, long, long time. Yeah. And it took a bloody long time for these assets to be frozen or for action to be taken, as far as I'm concerned. When the assets were frozen, well, then you can't trade on these assets anymore, which means stop everything. And now we're doing a proper investigation. And as soon as the layers were peeled back, it was just completely rotten.
It was gone, yeah.
So there was
over $1 billion was invested in there, wasn't there?
It is over $1 billion. Yeah. So, all right. So what does this mean for this individual? Well, the balance has fallen down to, for that particular investment, has fallen down to almost zero, because when they've looked at the underlying assets within that fund, they've realised that they are enormously down on the otherwise reported value.
Yeah.
It stands to reason that if you had a fund that's worth $1 million, then the underlying assets that are within that fund should be very close to $1 million, unless there's some really interesting, unique reason otherwise. And so in this case, it was clear that there was a huge reporting issue, a fraudulent reporting issue around what the real value of those underlying assets was.
And where it'd gone.
Yeah. So firstly, let's talk about what's going to happen. So the first step, this is investigated by ASIC, and ASIC would very likely be giving a determination to say that these individuals need to be remediated.
Yeah.
And I dare say, I don't want to be too assumptive, but based on everything that I've read, there's a lot of conjecture that it's just a full remediation. It's not like you are partially liable here. It's just fully fledged liable.
Yeah.
Now, this would also intersect with a group that's called AFCA, which is the Australian Financial Complaints Authority.
Yep.
And so
it used to be called FOSS.
Yeah, Financial Ombudsman Service. Yep. Yeah. And so AFCA is designed to step in when you wish to make a complaint against a financial service.
Yeah.
And you can do that at no cost. And when you go, you can either lawyer up or you can do it yourself. And then when you go through that process, then AFCA would make a determination as to what amount of money was owed. So let's imagine that you go through this process and AFCA determines that, for instance, the full 94K in this case is owing.
It's fraudulent, yep.
In that scenario, then AFCA would likely make a determination that First Guardian owes the full 94 to you.
Yeah.
Now we get to this next problem, that First Guardian is insolvent. It has no money because the whole thing, this scheme is blown up. And so despite the fact that AFCA releases a determination to say, hey, there's 94K owing, Well, actually, there's no one that will pay the 94K. The company's wound up and it's done.
And the individuals who probably will be bankrupted.
Correct. Yeah. Well, sometimes. Yeah. So if we can go back a few years ago, because this makes my blood boil, which is we go back to Dixon Advisory. Yeah. We saw a similar issue with Dixon Advisory, whereby Dixon was selling its own products,
internal product,
heavily conflicted, and people lost a bucket load of money on these Dixon, I think, commercial property investments predominantly.
Yeah.
And Dixon wound up the company and then moved all of the financial advisors and all the clients to a different entity so that company had zero value and had no assets, so that no one could sue.
Yeah.
And
they went through AFCA,
and the business continued on its merry way. And that, or at least to rephrase, the advisors, all that sort of thing, that continued.
Yeah.
And that is infuriating for us for a couple of reasons, right? The first reason is because it puts a heap of distrust in the financial advisory system, and number one. But number two is because you and I wrote a check.
We had to pay for it.
That's right. So let's move down, and we'll talk about that now with AFCA. When you get to a scenario where whether it's Dixon or alternatively with First Guardian, where AFCA says, yes, you owe this client $100,000, and the entity says we have no asset.
If we got a complaint or a determination, which we never have, I don't think you have either, then we would pay that out of our pocket, or we'd claim on our insurance, our professional indemnity insurance to pay it.
That's exactly right, yeah.
Out of our pocket, yeah.
Yeah. And so there will be scenarios whereby a company is wound up or it goes into liquidation for more legitimate reasons, and in that situation, there's technically no money to pay out.
Yeah.
So that's where we introduce this last step, which is called the CSLR.
Another acronym, yep. Explain this one for me.
This is the Compensation Scheme of Last Resort.
And it's been in the financial media a lot, not necessarily in the broader media.
Correct.
Good, because the acronyms are pretty confusing.
So just to be clear, you've gone to AFCA, you've got a determination from them saying, yep, were given poor advice, you were not looked after, there is remediation, and then the company or the organisation that are due to remediate you do not remediate you for the full amount.
Yeah.
So for any unpaid determinations from AFCA's decided that this much needs to be paid and you haven't received the full amount, that is where the CSLR will apply.
Yeah. And
the compensation scheme of last resort is designed to say, okay, well, AFCA determined that you were supposed to pay out, you were supposed to receive $100,000. You didn't because the company was insolvent. So therefore, we will pay you $100,000 via this scheme. So where does the money come from? It comes from financial advisors. Yeah. Every financial advisor in the country, currently, we'll say for simplicity, 15,000, a little bit less. Every financial advisor in the country will have to come together and they will say last year, the total CSLR payments were, for example, just very, very clean number, 15 million, because it's so simple. All right, well, if it's 15 million, and there's 15,000, that means every advisor has to pay $1,000 each.
Yep.
That is a compulsory payment in order to keep your license.
And we don't know what that is until it comes through.
That's right.
So we get an invoice at the end of the year.
Yeah, and as directors of financial advisory businesses, of course, we're not asking our employees to make that payment, which means that how many advisors do you have in your team? 5. So that means that you as a director are paying for 5 times that number.
Yeah.
And what's more, the number's never $1,000. It most recently has been 2.5 to 3.
Very inequitable. And you think about it, particularly when the advice industry is halved from 30,000. This is getting into our business quite a bit, but halved from 30,000 to 15,000 within the last 10 years.
Yeah. Look, it's an important scheme. I believe in the scheme, but I do find it frustrating. Not just that these events happen, but then also that the reality is that this event is going to cost me as an individual $10,000
more money, exactly.
Yeah, despite the fact that we've had no involvement with the issue per se.
And I think when people and advisors can see what's happening, you could see this as like a slow train wreck, essentially. But ASIC doesn't have the ability to be proactive, apparently, to be more proactive on shutting these things down as they're happening. And that's probably what's frustrating to the industry, and probably frustrating to the people that are stuck in there more than anything.
Yeah. Well, because we were. Broadly, because we struggled to get this one resolved quickly and brought to a close and, so to speak, frozen really, really quickly.
Yeah.
Because of that, then so many more people are affected.
Yeah.
How's that good?
There was still money coming in.
It's not good for anyone. So Let's go back. So if we think about this individual distressed, I'm pleased that your loss was less than 150,000 because the compensation scheme of last resort is not an unlimited amount per individual. It is capped at 150K. So based on what I'm seeing, my intuition, not legal advice, please go through the process, but my experience looking at these sort of cases is that it's very likely that in time you will be remediated for I'd like to say this entire shortfall. The only question on my mind is that it says the balance has fallen from 134 to 40. The question in my mind's eye is 130, was that ever real?
Yeah.
So for example, if we encountered someone who had sat down with an advisor that said, great news, I invested $1,000 yesterday, it's now $5 million. Yeah. And then the next day said, oh no, I went insolvent. They're not owed $5 million because that was a misrepresentation, but it's not practical to assume that you should be entitled to that misrepresentation.
Yeah.
So I'm not quite sure what your super balance was beforehand and so on, but if it was 134 and that 134 was based on what it could be perceived to be a realistic valuation, maybe you went in 2 years ago with 110 or something along those lines, and then I'd like to think that you're going to get the full amount via the compensation scheme of last resort.
Yeah, I think what's interesting, I thought it was worth looking at how long these things can take. So your complaints with AFCA, I think it's like usually 30 days, and you have 6 years until you have to make a claim. I guess it probably changed when they go into insolvency. And once it's referred to CSLR, it can take at least 12 weeks to get any sort of finalisation out of the CSLR as well. So you're looking at, anywhere up to 6, 7, 8 months before you might see any movement on this.
Let's go back to this idea of how you can avoid it. For most Australians, we want there to be as much. We have a vested interest in there being as much trust in financial services as possible, and this doesn't help. Yeah. How could people have practically avoided this and not have got wound up in it?
One thing I see, and it isn't, we advertise as well, but I think one thing I always say is anything that's being heavy paid advertising, and sometimes hard to tell that it's paid advertising when it comes through organically on your Instagram or your YouTube or your Facebook, and it's deliberately targeted. But heavily paid advertising is always a red flag to me. Not saying that there's large groups that advertise broadly and there's nothing wrong with them, but I think heavily advertising comparison tools, and where a message is about comparing, swapping, like that sort of direct comparison, as opposed to advertising the details of a product. Message. Yeah. If their product made sense on its own, they wouldn't talk about switching. They just talk about the merits of that product. So I always worry about advertising, even though we do it probably heavily as well.
We also advertise. A lot of businesses market their services.
Yeah, we need to.
But I think the distinction, I've never seen one of your ads say, "Hey, come with us and switch your super." Yeah, like that.
We're not selling on performance.
Yeah, and you're not selling a product. Yeah. You're selling a service, and if there are some product recommendations as part of that service, so be it. I'm proud to say that we've had people come through that we give advice to where there are no product recommendations because the advice is more service based than it is advice based. So the same thing, particularly product based advertising.
Yeah.
That's a big red flag.
And you can tell from if you put your details in and immediately get a phone call, I'm assuming that's what would have happened here. And even if the phone call is not aggressive, because there was talk that there wasn't aggressive sales, but if it's that quick, then it's something set up to make quick money usually. I'm always wary of one where, and this is probably advice, which is you need to know where your money is being invested. So we might use something like a separately managed account where we have the ability to manage money for our clients. But in every case, you'll be able to see where every dollar of that money has gone into, what investments it's gone into. Whereas in these cases, and maybe it was falsified, so you couldn't actually tell, but always demand before the money goes in to see exactly where it's going to be invested, because that is a basic requirement, something that every advisor can do in about 8 milliseconds and provide you with, and should be in every piece of documentation you receive.
Yeah, I'm with you on that. I've got one more thing here, which is around the idea of unsolicited contact. Yeah. So I get a lot of unsolicited contact. I'm sure you do too. Yeah, that's right. But it's not from financial advisors. It's from businesses. It's the LinkedIn message.
Yeah, that Optus, Medibank, all those details.
That's right. Yeah, you got to stop giving your information away, mate. Yeah. So which of my credit card numbers do you need?
Yeah.
So
CCV, yeah.
So in this case, I think about with my LinkedIn, I'm sure you get the same. You would get dozens of people every week saying, "Hey Drew, nice to meet you. We offer services like A and B and C, so great to connect, let's chat." I will almost never engage with those individuals. The very best that you're going to get from me is curiosity about the service, at which point I'm going to do my own research and it's highly unlikely I'm going to come back to you as the individual to get that to get that service completed, because I'll trust my ability to either find someone find someone very reputable. And if it transpires that as I do my research, that person is you, then great, no problem. But yeah, that concept of unsolicited contact. If someone is getting in touch with me saying, hey, I've got this great product for you, and this is not a channel that you've gone through and you found on your own merits, from the very get-go, you should be guarded about that. And you should be mindful that I actually don't know who this person is, and they may present very well, but I can't understand if they have an ulterior motive. Look at all the reviews, do all that sort of stuff, and I think over time that will help. And
nothing's guaranteed in financial advice. So if you meet someone that's saying your performance will be better and has certainty around what they're doing and saying, that's always a red flag to me as well, that you will definitely do better by changing to this product.
Well, look, I'm sorry that this happened distressed. Yeah, this is a horrible situation to happen, but hopefully that information was valuable. And again, it just speaks to the idea of being diligent. Financial advice is incredibly valuable. It goes without saying that I'm going to pipe the value of financial advice, but yeah, doing that due diligence and feeling really confident that you've got the right people in your corner is a huge part of it.
100%.
Thank you, everyone. What a bloody fun show that was. We talked about getting injured ourselves. We talked about avoid transaction fees and then avoiding getting scammed. So hopefully it was valuable, and we are looking forward to presenting some perhaps more upbeat content next time we do this.
We'll do our best.
So thank you to everyone. Looking forward to chatting to you all soon.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.